Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, the weekly podcast that sums up market movements and events from the past week along with their implications on asset markets. I'm Castellino, your host for this week's episode. On the global front, the Houthis' blockade of the Red Sea following resumption of the US-Iran hostilities drove a sharp increase in energy prices and bond yields. WTI crude crossed $90 per barrel and the US 10-year yield pushed above 4.7%. We expect the US electoral constraints and Iranian restraint to limit further escalation, keeping WTI largely within the USD 70 to 90 per barrel range ahead. Major central banks are expected to stay on hold this month as they assess the inflation impact. ECB has already held at 2.25% and we see Fed on hold through the year end given softer June US inflation. On equities, we believe earnings will trump geopolitics. The projected S&P 500 earnings growth of 15 to 20% in 2026 and 2027 should cushion any rate-driven valuation pressures. Coming to the key India macro data and developments from last week, one of the encouraging data points that came in was from India's core industrial sector. The index of core industries grew 5% year-on-year in June, up from 3.2% in May, marking the strongest growth in 5 months. The release also introduced a revised series with a new base year and, for the first time, included iron ore as a core industry. Iron ore was a standout performer, while electricity and cement also posted healthy growth. On the other hand, some energy-linked sectors such as refining, crude oil and fertilizers remained under pressure. Overall growth for April to June quarter came in at 3.6%, a notable improvement from 1% in the same period last year, suggesting industrial activity continues to show resilience despite a challenging inflation backdrop. On the external front, India's forex reserves continue to strengthen, rising by 1.08 billion USD to 676.2 billion USD in the week ended July 17th, marking a second consecutive weekly increase. The recovery was largely driven by a strong rise in foreign currency assets. The improvement reflects the positive impact of RBI's recent measures to attract overseas capital. Between June 8th and July 17th, the central bank mobilized 20.7 billion USD through incentives aimed at encouraging foreign borrowings and NRI deposits, with FCNRB deposits accounting for bulk of the inflows. Going forward, these measures are expected to support India's external balances, improve likelihood of a modest balance of payment surplus in FY27, and help moderate depreciation pressures on the rupee. Now turning to Indian markets, it was a weaker week across the board, with both headline and broader indices under pressure. Nifty fell 2.33% to close at 23,767, while Sensex dropped 2.68%. Broader markets also declined, with the mid-cap index down 1.29% and the small-cap index down by about 2.18%. On the sectoral front, the realty sector fell by 4.02%, as continued worries over elevated borrowing costs weighed on sentiment and dampened home loan affordability, keeping the rate-sensitive sector under pressure for a second straight week. Banks declined by 3.12% as major banking stocks declined after June quarter results showed weaker than expected NIMs at several large private lenders despite decent headline profit growth. Investors focused more on the margin pressures and the cautious forward guidance, including some banks lowering their profitability outlook, than on the current quarter's numbers, dragging the broader banking index lower, with rising crude prices and geopolitical tensions adding to the cautious sentiment. IG gave back some of last week's gains as enthusiasm around potential Fed easing faded and investor focus shifted to the upcoming earnings season. Energy stocks also edged lower, with higher crude prices creating concerns around input costs and margins for refiners and fuel marketers. On the positive side, auto and FMCG were the only sectors to end the week in green, benefiting from a rotation into domestic demand and defensive themes, as geopolitical tensions in the Middle East kept overall market sentiment cautious. The rupee weakened further against the dollar, up 0.3% for the week, to close at 96.57, extending its slide as the oil spike and broader dollar strength continued to weigh on the currency. Bond yields moved higher across the curve this week, driven by the global oil price spike and its knock on inflation risk. At the shorter end, the 3-year G-Sec yield rose about 7.7 basis points to 6.32%, while 5-year rose a milder 3.3 bips to 6.49%. The 10-year benchmark rose about 4.5 basis points to 6.82%, marking its third straight weekly increase and tracking the broader global movement in yields on back of the renewed Middle East tensions. While domestic equity and bond markets remain under pressure, domestic gold prices inched higher by 1.8%, benefiting from safe haven demand and rupee weakness, reinforcing its role as a portfolio hedge during periods of heightened uncertainty. That's all for this week's edition of The Week That Was. If you found this update useful, don't forget to like, share, and subscribe. Thanks for tuning in and have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.